Welcome, everyone. I'm Dan Jones, the Deputy Editor of Investors Chronicle. In this, our penultimate session of the day, we're looking at emerging markets. It's an asset class that has, in some ways, been forgotten over recent months, given the volatility we've seen in developed markets, on top of the underperformance we've seen in many regions in recent years. But on a country level, clearly, there's been a lot going on. Russia is understandably now persona non grata following its invasion of Ukraine. And Chinese market sentiment has been affected pretty severely by government crackdowns on various parts of the market, as well as property market struggles. But whether it be China or India, Latin America, or smaller emerging markets, there are plenty of opportunities, I think, still out there for investors, certainly for those who are prepared to accept the risk-reward trade-off. So that's what we're going to be looking at today. A little bit of housekeeping to begin with. Please be sure to ask questions if you have them using the box on your screens. This session will be available for 30 days after the event, a few hours after the event, if you want to go back and listen again to any part of it, or if you miss any part of it. And finally, there are some links and useful documents and resources available to you through the links on screen as well. So to our panelists, joining me today to discuss the risks and potential rewards in emerging markets are Nirgunan Tirucheliam, Head of Consumer Equity Research at Telema, Priscilla Liu, Senior Vice President at Radiant Global Advisors, Dr. Pen Cheng, Director at Providence, and Alpesh Patel, an advisor to the Department for International Trade and a fund manager. Welcome, everyone. I want to start with China. Investors have had a lot to worry about this year, and China is perhaps a subject they've been worrying about in 2022 and 2021. My first question, which I will start with Nirgunan, and put this to you. Does the risk of political or regulatory change in China, as we've seen in recent months, does that mean investing in the country is arguably harder than it has been for years, if not longer than that? How do you see the picture for people wanting to take advantage of the opportunities in China?
The first thing you need to understand is that investing in emerging markets is fraught with risks. And investing in China is no different from investing in the entire asset class. China presents very serious opportunities and challenges, and the crackdown on tech that we've seen over the last year is an indication of the fickleness of the regulatory regime in that country. Having said that, many of the tech names in China are cash generative. Many of them have a pathway to profitability. Some of them are already intensely profitable. So there could be a situation where investors could find a number of stocks trading at a discount to their intrinsic value. The crackdown and the sell-off may have created some serious opportunities.
Priscilla, would you agree with that? How do you see the situation in China?
Well, actually, from my observations, the general risk of investing in China is actually not much different than it has ever been. Right? China continues to be a one-party autocratic government. Its regulators has always been interventionist and experimental. The policy making are always like 2 steps forward and 1 step back. And the Asian market has been at 25% volatility for a long time. This is much higher than the average volatility of a US stock. So in my understanding, risk has now become larger recently. And actually, I think in many other aspects, it is actually less risky to invest in China today. There's much better market liquidity. Global investors now have access towards a well-diversified portfolio of Chinese stock across different sectors. So now they don't need to focus their portfolio exclusively on those like American ADRs that highly concentrated on the consumer tax. And there are more global institutional investors in the market helping with price discovery. So actually, I think the overall risk level is actually decreasing investing in China. But I do agree that there may be regulatory risk investing in either onshore or offshore stocks, And that's the risk that investor has to bear when making investment in China.
I'll pass it on now to Peng. How do you see investing in China?
Yeah, thank you, Dan. I think the points raised so far is very well. I'll just point out that very similarly that investing in China nowadays is much easier, and in some aspect it's less risky. Now, obviously, you have to, understand the headline news compared to what's on the ground. I just checked the performance of Chinese stock market, onshore market, a few days ago. It actually outperformed, some of the major global markets so far this year. Although it's still negative, but still, it has done better. But if you read the headline news, you will think that things are, falling off the bottom. That being said, I want to zoom in a little bit on the tech regulatory issue you brought up. This is not unique to China. And if you look at what the Chinese regulator tried to tackle on the data privacy, monopoly, potential monopoly or oligopoly type of plays by these huge, tech companies, it's no different than how the Western countries such as U.S. and Europe try to deal with Google, Amazon, and so on and so forth. The unique situation in China is that part of their system is that they can take very swift and forceful actions compared to some of the other countries. That's just the uniqueness of Chinese system. And when the regulator are more in favor, quote unquote, to certain industries and companies, then you're going to see the backwind. But right now, given these issues that they're trying to tackle, it created huge headwind in certain sectors. And that's what you're seeing. And like Priscilla pointed out, the regulator, they will self-correct, but it will actually take some time, just like in every other country. So you have to understand that the whole situation, the backdrop, as well as sort of unique characteristics in China. And so I would also agree that because of the uncertainty and because of the market downturn, you are going to see more and more opportunity actually in China. Now, obviously, it comes along with the risk, and we have always need to mention there's a lot of risk involved in investing in investing in China in particular, and so you have to be very careful. But you really have to dig into more, and personally, I see opportunities myself.
Thank you. I think that's definitely the case. That it's the ability of regulators to act quickly is the difference there. Alpesh, what's your take on the whole issue?
I'm afraid it's quite different to everyone else. On 9/11, I was in Beijing. I was lecturing at the University of International Business, and I fell in love with China. And I, for years afterwards, was telling people initially buy the ADRs of Chinese listed companies, the ADRs, because you've got the US regulation and all the rest of it. My last visit to China was just as COVID was breaking out. I was in Beijing, and over the last few years, I've been falling out of love with it. For this major reason, I have not seen the West more aggressive towards China than probably pre-Nixon days. And we're forgetting that. And we're forgetting that there's pressure from governments in the West to move out of China. It's not as overt as it is towards Russia, where it is very clear we want Russia to fail, but the wind seems to be blowing very aggressively from the West against having production in China, having capital in China, and then you've got the ESG side. And every ESG conference I go to, there'll be somebody saying, well, wait a minute, what about the Uyghurs? Now, we care about that. They don't. And whatever the politics of it is, and whichever side you're on, certainly one thing's clear, the Western mood is on the ESG side. Where the heck are these funds from the West going to be putting their money into China and getting away with it? They're not, because the public opinion is going to be pushing it in the other direction. And, it's communist, autocratic, dictatorial, and the human rights thing comes up. So I'm worried. But if I forget all of that, there are companies I can do my normal fund manager analysis, and I've done it with China, and I've said, okay, let's look at the sectors with moderate price to earnings, a good valuation, good forecast growth. So forget the political issues I just mentioned. Let's assume I'm just wrong and none of that's happening and it won't make a difference for a minute. Then I look at some of the infrastructure companies, and you're right. I can see companies here where in healthcare, for instance, good valuations, good forecast growth. And I could pick some of those and think, well, okay, that's fine. I've got companies here which are up 48% in a year in healthcare or other such sectors. I'd probably be looking at energy at the moment, utilities, materials. I wouldn't be looking at telecoms, consumer staples, or consumer discretionary just because forecast growth is not that fantastic as a broad measure and valuations are a bit high. So you can still do the regular analysis, but overlaid that, I'm too scared in terms of, given what I've seen happen with the West and Russia, that the push is going to be more that way and that kind of pressure on Western funds and Western capital. And that's why you don't need Western capital. They've got their own capital. Yep, that's fine.
I was going to come to the geopolitical risk, and we have had a question to that end. Nick, then how do you see that risk? In a extreme scenario, hopefully an extreme scenario where China, the tensions with Taiwan are stoked up. We get a similar amount of pressure for Western investors to divest from China as we've seen with Russia. I mean, that's much harder to envisage given the scale of capital invested over there relative to Russia. But how do you see that risk, rising up the agenda, perhaps?
That's a risk that investors need to consider. Yes?
Yes, sorry, go on.
That's a risk that investors need to factor into their understanding of the opportunities in China. The Ukraine war, in many ways, is a game changer, where the divide between the West and the former communist states has now actually widened, where there's a risk of a renewal of some of the Cold War rivalries. And in this case, there's a possibility that tensions could escalate. But at this point, the chances of China taking on an aggressive posture towards Taiwan are relatively moderate compared to some earlier instances in history. So I wouldn't place the risk of a geopolitical tension between China and Taiwan at a particularly high level at this point.
Thank you. Let's shift back to sort of the company focus for a moment. And one thing we've looked at in our funds coverage on the ICE recently is we monitor how fund managers are looking at things, and given the concerns people have had about regulatory impact, one thing we've seen is some professional fund managers, investing more in state-backed companies. Obviously, that brings perhaps issues of its own in terms of liquidity and shareholder rights, but it does, I think, from their perspective, mean they are a little more aligned with what policymakers are looking at. Priscilla, how do you sort of see those opportunities if there are such things? Certainly for professional investors looking at the domestic Chinese market to be investing in these kind of state-backed areas. Is that a safer way of accessing the country?
Yeah, I think it's important to know that China and actually many other emerging markets are actually dominated by those state-owned enterprises. And there's a historical bias that these state-owned enterprises are just bad. They are inefficient, corrupt, not ready for profit. So the question is the story correct for China? Well, my answer is not simply yes or no. If you look deeper into the Chinese state-owned enterprises, you will realize that there are two groups of them. There are locally connected SOEs that tends to be more likely to be corrupt. They focus more on ensuring employment than on profitability. And they survive largely due to the substantial amount of government subsidies. But on the other side, there are centrally connected SOEs. They tend to be more efficient, they have higher profit margin, and statistically, those companies outperform the broad Asian market by 2% a year, while locally connected SOEs underperform by 6% a year. So in short, not all the SOEs are bad. And I guess a more relevant issue for our investors here today is that it is the right time to invest in the Chinese SOEs. And my answer is yes. And I think there are two contributing factors for that. First of all, 2022 is an election year in China. And we know that those state-owned enterprises tend to outperform on an election year historically. And secondly, after Shanghai's 3 months COVID lockdown, in order to catch up with the country's GDP target this year, it is more likely for the government to announce easing policies. And we know that those easing policies will benefit SOEs the most.
Peng, what's your thoughts on that policy in terms of investing in China?
Yeah, I think Priscilla pointed out some really good points. I just want to add that the SOEs are no different than some of the other, government-owned enterprises in other countries where they do have a goal of generating profit, returning returns to shareholders, but at the same time, they are state-owned and they play another role. Sometimes in China, it's employment, sometimes it's price stability, and so on and so forth. The way I have always looked at state-owned enterprise over the long-term investing is that in China, particular, is that it's probably a very good way to participate in the long-term growth of China. Because if you look at the SOEs, they tend to have a large presence and market share in various sectors and industries. And if you want to look at China and just say, hey, I'm not sure, which sector, which industry, which company, but I want to build a very diversified portfolio. And over time, I know Chinese economy is growing faster. I just want to, enjoy the economic benefit, the returns coming from those higher growth. And I think the SOEs will provide a very good way, again, in a diversified way, portfolio that to access the long-term growth. You're going to see a lot of short-term up and downs, and you're going to see, political, regulatory risk up and down. But one thing I think China is very firmly on the market-driven economy side, and you're going to see these SOEs, getting the benefits of these higher economic growth over time because of their presence and positions and so forth. And that's how I look at it.
We could spend the whole session on China, and we have indeed had a couple more questions to that end, but I do want to make sure we cover some other areas first, so hopefully we'll be able to come back to that later on. But let's keep it on a country by country basis for now. Maybe turn to India, which again has been one of the more resilient emerging markets this year, in terms of stock market performance and overall level. Alpesh, how do you see some of the opportunities there in terms of India now perhaps being the preeminent emerging market?
Well, we've been investing there from a private equity angle for years, and we know it's a difficult market. Again, if I apply the metrics that we do across all countries, we look at the valuations, both at the country level, multiple of about 20 overall, which isn't too expensive at all. It's almost half of what China's is. And I then look at that across the various sectors. Again, there's a lot of expensive sectors, no surprises there, just as you'd get in China. There's a lot of low growth ones. You look at real estate, consumer discretionary, very expensive. Forecast growth, okay, it sort of matches it. And then I drill down to the individual companies, and yes, there's some opportunities. I sometimes joke in my webinars that I'm not a racist when it comes to fund picking. Actually, I'm not a racist generally, but when it comes to fund selections, I don't care if they're Indian or Chinese or whatever else. What I care about is what do the numbers look like. So if we then drill down to a Mahindra & Mahindra or a Bajaj Auto and compare that to whatever other company, as long as the numbers stack up, that's fine. Put aside political risk or any other risk. So I'd say, yeah, I'm happy to look at the market because it opens up a whole bunch more companies to us and taps into, therefore, a bigger pool to fish from, because the more things we can filter on our database, more companies we can filter, the more likely we're going to get a narrow pool of very good ones, and that's why we look at it and we treat India just like that, not because it's India, but just because it's more companies, and there are some of them which do rise to the top in terms of growth, valuations, cash flows. They meet all our metrics.
Nick, and is India a market, you think is worth investors considering more closely at the moment? How do you see the state of things over there?
There's no doubt that India is at the center of the growth story in emerging markets. It's a massive opportunity. We need to make a distinction between the prospects for the Indian economy and the prospects for investing in that capital market. India is now emerging out of a devastating COVID episode. Even a casual visitor to India, where one meets companies and business leaders, would be struck by the strong sense of optimism among the corporate leaders, as well as the consumerism that's engulfing their country. However, the deals that we've seen out of India recently, the IPOs such as Zomato, Paytm, and the like, have been very poorly received. They've actually done very badly, having been valued at an elevated valuation at the IPO stage. So we need to be very careful in assessing the risks in that market and not getting ahead of ourselves in paying an excessive premium for the Indian growth story.
Thank you. I'm going to move away slightly from sort of a country by country basis for a moment and just ask a bit more of a macro question on the dollar. And obviously the US dollar has been very strong this year again. It seems every year almost there is a prediction that the dollar will weaken over the course of the year, and invariably it tends to get stronger and stronger. And that presents a headwind for a lot of emerging markets. And has been a barrier to investment for that reason, perhaps. Peng, how do you sort of factor in currency considerations when looking at these markets?
Yes, that's a very good question. And when you're investing in foreign countries, particularly emerging countries, currency sometimes can play a significant role. Now, I want to again, zoom out a little bit, look at long term first, and then we can talk a little bit about the current situation. Over time, different countries have different experiences, but currency tend not to over time play a huge important role in the long-term risk return economic trade-off, unless we're into some of these hyperinflation and default type of situations. So that's my baseline over long term. Now, if you look at short term and where the situation, the inflation's going, and the U.S. raising rate, you are seeing U.S. dollar, liquidity pulling out of the market, and what you're seeing is more money is flowing into U.S. dollar denominated assets, and that will for short term definitely hurt the emerging market, and so on and so forth. And you already start to see that happening. That some of the emerging market are experiencing both, pressure in terms of performancing of the asset class, assets locally, as well as the currency. And this is not unique to emerging market, but also to many of the developed markets. You're seeing this situation, but to different degrees. So you're gonna see that, and that come with the emerging market investing, and it's not unique to this particular period. I think for certain countries, they might be more equipped to deal with it. Again, we talked a little bit about China before. If you look at China, they have a very strict, capital control scheme, and so to some degree, compared to countries without that, they will have this additional tool in their toolbox to deal with these situations. And but nonetheless, even if you look at Chinese currency, it's already depreciated around 10% against U.S. dollar.
Alpesh, how do you view, the strength of the dollar vis-a-vis its effect on emerging markets?
Yeah, I mean, what else would you want to be really owning right now? And you're panicking about the rest of the world going to hell in a handcart, and you're thinking to yourself, right, well, I'm going to sell my overseas assets in riskier economies, bring the money back to Uncle Sam, and there's trillions of a cash pile sitting there, which eventually, because currencies tend to rebalance, and eventually the money will say, well, wait a minute, I've got all this firepower now where I can buy cheap foreign assets. So I guess what will eventually happen, and it may well happen to emerging markets, I don't think it'll happen within the next 8 months. It'll be a bit longer than that. People will start buying up what in dollar terms, and people who've got dollars, look cheaper foreign assets because of the strength of the dollar. So there will be some positive benefit eventually to emerging markets. But as I said before, rising interest rates, cost of living crisis, higher oil prices, basically uncertainty in the world, and then the Russia situation, yeah, you're going to hold the dollar. I mean, I was told on social media it was going to be Bitcoin and dollar wouldn't be the world reserve currency, but look how wrong social media was. It appears that it is the almighty dollar, which is the safe haven for the moment. And that also tells you that there's a problem with emerging markets still. I mean, that's why they're emerging, which is it's great in risk appetite, risk on times, but unless I can find lack of correlation to the declining Western markets, and I can't right now, Brazil might be an exception in the short term, then I'm going to be holding dollars and cash in emerging markets. I'll just have to wait for another 8 months before I think about them rebounding.
We've had a few questions in on broadly relating to a common, I think, concern of investors in emerging markets, which is to do with disclosure and accountability and issues of that nature. Priscilla, perhaps if we, I suppose, look back at China again, which is obviously the focal point of a lot of people in terms of their investment opportunities and things like that. Both in China and emerging markets in general, how would you characterize the state of disclosure for investors, looking to buy into these companies?
Well, I guess this is actually an issue that is like headlines in a lot of like US news. And actually, over the past several years, I actually have seen the disclosure problem getting mitigated as time passed. And like speaking of accounting standard, we now like investors are able to like kind of diagnose the kind of accounting problem that's in the Chinese accounting standard. And for the government side, there's much like their requirement on the accounting standard is getting much more like detailed orientated, and it is very hard for companies to manipulate their accounting numbers. But on the other side, I do see that a lot of Chinese companies trying to reserve for profit. Like for example, they may want to delay the profit like this year and to put it in the next year. And the reason for that is because like once a company makes consecutive like negative profit, it may has a higher risk of being delisted. So there are kinds of profit management like that. And if you look at the like profit cut, you will realize that like for a lot of but like in China, there's a clear cut around zero, while in US you can see a kind of normally distributed shape. So yes, I do agree that there are some problems in China, but actually it is getting better and better.
Peng, how do you feel about this, particularly perhaps in the context where a lot, but not all investors, but a lot of investors are increasingly looking for a lot more disclosure, particularly around ESG issues. There's struggles with that for companies all over the world, but how do you see emerging market disclosure in general, and maybe from the point of view of providing more information on the sustainability of their companies?
Right. I think first of all, you correctly pointed out that ESG is very important from all three aspects: environmental, social, and governance. And it's a relatively new area. The disclosure certainly has been issued not just with the companies itself, but also with the asset management industry, investors. We recently have some headline news of European, U.S. very well respected firms run into issues with disclosure. Now, part of the issue is that the fundamental data the company needs to get up to speed to report. Part of it is the lack of industry standard in terms of how do you call certain things and so on and so forth. We're not going to get into that. And just like all these other information in emerging markets, it's the disclosure standard is still developing. And so for a newer area like ESG, it's not surprising that you're going to see more and more issues compared to a market in Europe or the US and so forth, where they're clearly ahead on some of these ESG things. That being said, I want to say a couple of things that I used to work at Morningstar, and just for example, Morningstar as a firm has started to devote a lot of resources building, for example, a on-the-ground team in Shanghai, with 20 to 30 analysts to target specifically on the ESG. So you're going to see not just Chinese local firms, but also international firms starting to deploy resources, demand better data, better transparency, and better reporting, and that will start to elevate that, pull it to closer to what we see in other markets in China as the example. That's one point I want to make. The second point you want to see is that we talked about the regulator headwind against the tech sector. And actually, I think in China, there is actually a lot of backwind in the ESG area, particularly environmental. You're going to see the government, in many aspects, being a little bit more aggressive to tackle these problems than some of these other countries. So in this particular area, I definitely see the current struggles we have in terms of getting good data standard, disclosure, reporting in emerging market, and particularly in China. But I'm reasonably optimistic by looking at the government and the industry players in terms of what they're trying to do and trying to get up speed and so on and so forth. And this is, again, not unique to China. I spent quite a bit of time in Singapore, and the Singapore regulator recently passed sweeping, reporting requirement across the board on a few on few industries and sectors. And I sit on a couple boards on the insurance sector side, on the asset management side. And even in marketing in Singapore, people are struggling trying to figure out how to report, how to comply, and how to, drill deeper, not just report, but be a force in, pushing ESG, forward. So it's not unique, but at the same time, I think you do need to understand that it's going to take some time. It's going to take some time. But the backwind, like I said, is in favor of this area.
Let's look at another area of emerging markets that has come back to, certainly to form and perhaps to investors' attention, given the commodities price surges we've seen over the past 12 months, or if not longer, and that's Latin America. Alpesh, you touched on this very briefly, the mention of Brazil. Obviously, there's interest given the price of metals, the price of oil, the price of commodities in general. Is that a region, a country that's been rising up your agenda, and how long does one expect that to continue? We've already seen quite a large run up in a lot of these prices.
So I thought, well, look, how would I play this? There's two ways of playing this whole thing. One is you look at the individual countries and take Brazil as an example. Then, as I said before, I look at the valuations and the growth. And energy obviously stands out, particularly for somebody like Brazil, head and shoulders above the others in terms of, yes, valuations are high, but growth is projected to be higher. And you've got a whole bunch of companies that come up which don't look too bad. You look at the numbers and suddenly on performance, Petro Rio up 27% in the past year, which actually is a laggard compared to some of the Western ones. I don't own these, by the way. Petro Reconcava, I butchered the name, 32%. But if I do it the other way and say, well, wait a minute, there's this whole commodities play, which isn't necessarily equities based, it's just on the raw commodities. And then we run that through a filter where we say, well, what's got momentum? What's got relatively low volatility? Because I don't want high volatility in this market. What's got a good sortino, good upside reward to downside risk alpha, outperforming the markets consistently. All the ETFs I can find are commodities. I don't have anything with frontier market named, emerging market named, LATAM, none of those. Every single one of those, when we run those through our filters, it becomes commodities. It becomes agricultural ETFs, soybean ones if you want to get really into it. There isn't country specific, there isn't market. So what I'd say is it's not geography, it's going to be return, and it's probably going to be sectoral rather than geography. And I think the label emerging market can sometimes be distracting because you think, oh, I'm getting diversification. You're not. You're getting correlation to the downside. Everything falls in this connected world together. And you're better off looking at the sectors, which may well then give you exposure to, you know, the energies coming out of Brazil, so be it. But at least you're getting the returns that you need in a market like this. So I think that's going to be a better play than just the country-specific look. Which I understand why fund managers have to do it. You know, you've got a job, you're paid, you go, oh, you're in charge of Brazil, you're in charge of emerging markets. Guess what? You've got a narrow gene pool. Whereas I think the sector-based fund managers have got a greater advantage because they've got the world to play in, albeit restricted to their sector. And I think that's a better place to be right now if you want to play the emerging. When you say emerging, you really want the returns. And those returns are a better way to access them through commodities, I think, than the country-specific way.
Yeah, I think that definitely will chime with our audience, given certainly in the UK, you know, the FTSE 100, for example, a lot of the stocks that our readers will own will be, you know, have a lot of exposure globally and to, of course, the commodities complex. Nick, and how do you see that kind of commodities, you know, resurgence playing out in terms of sectors, in terms of regions? You know, how do you look to take advantage of that?
Well, broadly speaking on commodities, I would say two things. Number one, there's been tremendous underinvestment in commodities since the crash of 2014. So the last 8 years has seen very little investment in energy, in agriculture, in metals and mining, and this has created the ideal conditions for another commodity super cycle. The second point that I would make fairly forcefully is that people have been talking about the inversion of the yield curve. And if you study the inversion of the yield curve, over the last, say, 15 years, or maybe 20 years, there's been 3 or 4 instances where there's been an inversion of the yield curve. So we've had it in 2000, in 2006, and in 2019, and we've just had it on Monday. If you go back into history, every single time that there's been an inversion of the yield curve, there's been an acceleration in commodity prices. Commodity prices have rallied by an average of 20% over the next 18 months. So we could see the inversion of the yield curve not signal a recession, but could signal a further rise in commodity prices on the back of some of the forces that I talked about earlier. So investors could get exposure to the commodity theme and to emerging markets by investing in the ETFs that Mr. Alpesh Patel talked about. And it's an excellent way for investors to get exposure both to the commodity story as well as emerging markets.
Peng, I think you wanted to make a point on this subject.
Yeah, I think for the most part, I agree with the other panel speakers on commodities. And when you're investing, you definitely have to look at the sector, and commodities being one of them currently. But I don't want to downplay the regional, the local as well. I think it has a role. We talked about currency. And in the case where we just talked about Brazil, you know, if you want to look at the country, certainly there's a commodity play, and it's right now it's in favor with the the commodities disruptions and energy prices, all of that. But at the same time, I just want to point out why the local point is also very important. If you look at Brazil, actually, in the higher inflation environment, you want the central bank to be very independent and very vigilant on inflation. And if you look across board, amazingly, Brazil actually have one of the, I would argue, most independent, central banks, and they have been very aggressive in terms of combating inflation in that market. So that gives me additional comfort when I'm looking at how to invest in these different countries, in addition to that sector view, which I wholeheartedly agree. And so I just want to add this little bit nuances. I think that when you're investing, you want to look at both the sector, which clearly play an important role, but also in terms of the regional or the country specific factors.
You mentioned inflation, and obviously, while the US and UK have been dealing with very high rates of inflation relative to recent history or the past few decades, emerging markets, in many cases, have had to deal with double-digit inflation levels regularly, if not constantly, over the past few years. I mean, is there much that we, in the Western world, or as maybe Western-focused investors, can learn from those experiences in terms of how these stories play out and how they might impact individual investments? Alpesh, I don't know if you kind of look at that relationship at all.
I've got the CPI figures for both the Western and the emerging markets on this. There were some news stories again about countries having to go to the IMF because inflation is just carrying away debt. They're getting into a vicious circle. The one lesson I think we can get from the West, from any economy which has suffered this, is, for God's sake, be scared senseless and make sure you stay well away from, and I'm looking at debt to GDP levels, your current account deficits, keep them in check well in advance, keep inflation in check well before it gets away. I mean, we're looking at Brazil, that CPI year on year is 11%. Can you imagine if it looks like we might be approaching that in Britain, an interest rate policy rate of 12.7%. We can't afford that. So I think the big lesson is just stay well clear of going down that path on anything which looks like would get you into more and more trouble, like increasing levels of debt. Just try and do everything to stamp it out early. And I think policymakers say that all the time, from the central banks to the IMF. The more action you can take early on, it's a heck of a lot easier to change course than later down the road where you've left it too long. As the Sri Lankans will tell you, as the Turks will well, the Turks are in denial, but they shouldn't be. They would tell you. And now it looks like Pakistan's got difficulties. So you've just got to get a grip with it very early on.
We've had a couple of questions come in about China's influence in other emerging markets, other regions, and obviously, as you'd expect from a giant economy, China has been investing a lot in other countries and all parts of the world in recent years. So I suppose the question is really, if you're an investor looking to avoid China, is such a thing still possible, really, given the extent of their influence now? Peng, how do you sort of see that situation if you're, sometimes people fail to recognize the extent of China's power nowadays if they're looking at their investments?
Yeah, I think compared to other countries, I think Russia, for example, I think in China, it's really a very integral part of the global economy, both particularly on the economic side, a little bit less so on the financial market side, just given the development stages. So I would say, yeah, I mean, it's very difficult to, at least in the very, very short term, from the economy perspective, to find ways to avoid China. And we have learned that during COVID, and you can see the supply chain and so forth working, are not working in certain aspects with or without China. And so I think I want to go back to a point I made a little bit earlier. I think in the media, because of the competition, if I can use that word, between the U.S. and China, there's a lot of negativity being portrayed in terms of what's happening, for example, in the U.S. media, what's happening in China, and vice versa in China in terms of what was happening, in the U.S. and so on and so forth. So I travel back and forth, Even during COVID, I was back and forth 4 times already. So you always have to switch your mindset. When you're in the US, when you read on China, you have to discount that. When you're in China, you read the US, you have to discount that. So my point is that in certain areas you're definitely seeing a decoupling very clearly, and the regulations are pushing that way. But in many other areas, you're seeing deeper collaboration, deeper economic activities, and those may not be surfaced in the media, in the popular press, but that's definitely happening. In terms of investing, I don't think you can, as a investor, as a rational, diversified investor, completely ignore China. It's just too big, too important, and you can clearly see the world leading asset managers, such as BlackRock and so on and so forth. They're increasingly, putting a more emphasis, as well as service providers, such as I mentioned, some of the names are pushing more into China, even with all the issues we talked about. So I don't think it's a good idea to just follow what's being talked about and just ignore it. It's too integrated right now. Even if you don't invest directly in China, in many ways, as you pointed out, it's connected, it's impacted, and so you have to be aware of that and going on. On the flip side, you mentioned the phenomenon that Chinese became a bigger investor overseas, and in certain markets, it can have a pretty big influence. For example, if you read the news the last few days, there has been an influx of Chinese investors in Singapore on the real estate sector, and despite the higher foreign buying tax, Chinese investors are bidding some of the property values higher and higher, and so so you got to be aware of that if you want to sell or buy in certain markets, and so there is a right or wrong, China is a big market, has a lot of money, wealth being generated, and in certain areas it's going to get significantly impacted. I just want to point that out. So you got to be aware of that as well, even if you're not investing directly into China.
We're coming to the end of our time shortly, and unfortunately, I'm not sure we'll be able to get through all questions, but one that has just popped up is quite a tricky one to answer, I'm sure, but I'm going to try it anyway. Nigel, and you mentioned the commodities, potential for another rally earlier. We've had a question about the super cycle, which is always the $64,000 question when it comes to commodities. What's your take on where we are in that cycle? Are we still is this kind of artificially impacted by supply issues, or is this maybe the start of something bigger for commodities, which, as we know, tend to move in these big cycles?
Yes, we could be at the start of a commodity super cycle because we've seen 8 years of underinvestment in commodities. So these things move in situations where you go from feast to famine and then from famine to feast. So we are in a situation where commodity prices could stay elevated for a number of years. That does not mean that it's going to move in a straight line. Along the way, there would be tremendous volatility. By the commodity super cycle is that for an extended period of, say, 10 years, commodity prices would be well above average, and there would be strong correlation between different types of commodities, between agricultural commodity prices, energy, metals and mining. One of the features of the previous commodity super cycle was how strongly allied to the oil price food prices were. And I think that's a factor that's going to drive this commodity super cycle as well.
Great, thank you. And thank you to all our panelists. We have now pretty much reached the end of our time, but it's been a great discussion. So thank you for taking part. Thank you to the audience for taking part as well. We've had a lot of questions. Apologies if we didn't get to yours. This is a big area. We've tried to cover as much ground as we can, and we hope you found that useful. Please do remember that there are more useful links and documents to be found via the links on your screen, which may answer some of the unanswered questions from this session. And there's a feedback form as well. And please do stay tuned for more Investors Chronicle events in future. You can do that via our website. And of course, we have one more session today as well, and a whole range of different sessions coming up tomorrow in this event. But that's it from me. Thank you very much, and goodbye.